A leading Italian economist warns that the United States monetary policy adjustments by the Federal Reserve are having huge and largely negative impacts on the 19-nation euro currency zone, especially high-debt countries like Italy. Marcello Massori, director of the School of European Political Economy at Rome's Lewis University, said in a recent interview with Xinhua that the moves by the U.S. Federal Reserve may have helped force the hand of the European Central Bank.
The monetary policy of the Federal Reserve can have an important impact on the European monetary policy for several different reasons. The first reason is that European Central Bank had to decide to strengthen its restrictive monetary policy in order to avoid to remain behind the structure of market interest rates increased because of the restrictive monetary policy implemented by the Federal Reserve. The second reason has to do with the exchange rates between dollar and euro. Obviously, in the moment in which the Federal Reserve decided to implement a stronger recessionary stance of its monetary policy, the impact of the exchange rate was quite important, and the depreciation of the euro towards the dollar had a negative impact on the price dynamics in the European Union and specifically in the euro area.
Massori said the inflation-related challenges the European Central Bank is facing are greater than those in the US because European countries are more dependent on energy imports and international supply chains, which are now disrupted by the ongoing Ukrainian crisis.
In particular, it's easier for the Federal Reserve to manage US inflation due to the fact that US inflation is, let me say, more traditional. That is right, due to the overheating of the American economy. At the opposite, in the European Union and specifically in the euro area, the main determinants of inflation remain bottlenecks on the supply side, and in particular, increasing prices in energy and food and raw materials. To handle supply bottlenecks is harder for monetary policy than to handle demand push inflation.
Massori further pointed out that restrictive monetary policy in the euro area could deal a blow to Italy, a country with high deficits.
Italy is particularly fragile towards a restrictive monetary policy in the euro area due to structural reasons. First of all, public debt. The consequence is that countries with high public debt, such as Italy, doesn't have a huge and important, significant fiscal capacity to handle a possible recessionary phase, to handle a possible stagflation.